Welcome to Beat the Markets.
I'm Ritger.
And I'm VKM. It's February 2018. The markets have fallen about 10% in the last week or so from peak to trough. We had a little bounce today. This is when you get all the phone calls and all the people out of the woodwork getting in touch with you to find out your thoughts. And since we have a show on the markets, I figure we're not going to be able to get away with not talking about the recent market activity. So let's talk about it and see what insights we can get from the market's behavior the last week or so.
All right. Yeah, it's been an extraordinary year. It started out a year ago with a very overvalued market and just ripped upwards, especially the second half of the year. It took off in a parabolic fashion. It was expensive and then it accelerated upwards. That was a unique situation. You have very rarely seen that in the U.S. stock market, especially the broader market. The Dow actually ripped the hardest.
Right, the Dow going parabolic was something noteworthy for sure. And that makes people that come out of a trading background a little bit...
I think whenever you see that, it's a sign of all the newbies getting in. Nobody, it's just that pile-on effect of, you know, some guy makes money, he tells his friends all the money he's making, a couple more come on, and then the eagerness to buy goes up. The faster it goes up, the more eager people get, so the faster it goes up. And it's this feedback loop, but it always ends badly.
So I saw some chart where they're showing the amount of retail accounts being opened, and that was also going parabolic. And you know, parabolic moves from me being a layman's perspective of science, the way I look at it is it's unsustainable because the energy required to keep a parabolic move requires an increasing amount of energy. That energy can't be sustained.
Yes.
And then it collapses upon itself. The thing that I found most noteworthy, well, a lot of things, but one of the things I want to highlight is that, you know, for months we talked about the increasing risk of the market, and I don't want to use this as a view of like, hey, we were right, because that's not the takeaway lesson. You know, anybody can come up with all different kinds of viewpoints and opinions, and some will be right and some will be wrong. But what I wanted to highlight is that
congratulations, the market that had not fallen at all for a year, you predicted would at some point have a bad day.
Right. So yeah, I don't want to turn that. But the thing that's noteworthy is when the markets do become risky, or this elevated risk, you can look wrong for a long period of time. Yeah. But then when it turns, it's amazing how quickly the risk is exposed.
It's the reverse. It's the reverse of the Great Bottom in March '09. Do you remember how it just dribbled down? So yeah, we crashed in October, firmed up a little around Christmas time, and then we dribbled down through late January, all through February. It was like down 0.5% every day into the lows. And at that point, everybody was bearish. There's the DSI survey reading of traders, 95% of the trading public was bearish.
And a week ago, we were talking, the DSI was up in the 90. It was 2 or 1 in the bullish camp, which
94 was it? It was ridiculously. It was as high as it ever gets in the bullish camp.
Right.
And these both ended the same way, with a really sharp move. The initial rally in March '09 it just ripped. It leapt upwards.
Okay, so that leads us to where I want to steer the show is that, okay, so we know what happened. Some people that had the bearish persuasion was saying that the market's ripe for this. People that were bullish had a reason why the market was going up and had some explanation. But now we know what's happened, and the call that we get a lot is, well, what do we think? What do we think about the market? And kind of like that leads to what should I do? So I can take a stab at it, or if you have something you want to say.
I had a thought about growth rates. So, the market is a product of the organic world. We are animals, and it's constrained. Exponential growth has its limits. It doesn't matter if it's 1% a year or 17% a year like we've averaged in this bull market. You can't go on forever.
The old saying, trees don't grow to the sky.
Trees don't grow to the sky. Something has to give. So yeah, it's possible for a trader to take from the markets at a lifetime, average of 17%, like a George Soros or Buffett. But for the market as a whole to grow like that is impossible. Not, after inflation, we're talking about 15% in this bull market. It's impossible. Ultimately, the market is tied to, the fundamentals. It's tied to the cash flows of the underlying businesses, and those only grow at a few percent a year. And they can only grow a little bit faster than the economy, and they're only growing faster because they're pre-selected. Those are the winners already, the ones in the indices. But that's another story. But people get used to these big numbers, not realizing that a good rate of return is interest rates for over like all of human history have averaged something like 5%, say. So a number like 15 or 17% is just not sustainable. It can't go on. And so, so we've had a market that's compounded at this rate. It's way overshot all its long-term trends. It's way overvalued by any measure that has any validity. So what do you do? Yeah, it's the question. What do you do?
Before I get into that, just to your point about trees not going to the sky and what's a reasonable compounding rate, I might have mentioned it in a previous episode, but one of the stories I really love that illustrates the point is that old story of the Dutch buying the island of Manhattan from the native Indians. And the thing that you learn in school is, or at least in today's school especially, is that the Dutch ripped off the Indians because they bought it for $26 of like trinkets. But the thing that's amazing about compounding is that if those Indians could have, or Native Americans could have monetized that $26 of trinkets and compounded at 6% per year for 300 something years, it'd be worth more than the entire island of Manhattan. And that's no capital infusion on top of that.
Unfortunately, they didn't have any index funds back then.
But it shows you how hard it's really to get 6% over time.
Yeah, and it's hard to hold on. I mean, if you're talking about a long span of time, I mean, families grow and families fall apart.
And nations. And that's the thing.
On a long enough timeline, the survival rate for everybody goes to zero.
Right. So, but on a happier note, back to the market. So the thing that I get asked during the tumultuous time is, what do I think? So let's start with that. And I don't like that question. Well, I think it's the wrong question to ask because number one, what do I think? I can think a million things.
Yeah,
I'm a human. It's my
Yeah.
opinion. I mean, I can't help but think. I have an opinion. If you ask me what my opinion of this market is, I have one. But it's really useless.
Yeah.
And number two is, when I was younger and didn't really have I'd say as strong a framework of my approach to the markets, when tumultuous things happen, what people look for, and myself included, I get the dynamic, you look for a guru.
Yes.
You look for somebody that knows more than you. So what did I do? Something that happened that I didn't understand. So, like the '08 financial crisis, I thought I knew a lot about markets then, but I was out of my element. In terms of the whole construct of how things were
It's a
working.
shame we didn't know each other back then because I knew what was happening in the markets, but I was not a great trader. I traded it well on the downside, but I didn't control my risk on the upside. Whereas you wouldn't have made the same mistakes that I made, and I probably would have, beaten some bearishness into you in '07.
Yeah, you would have certainly helped.
I understood the macro setup there. I didn't know much about trading. But you were like a pure technical trader. You just traded the price.
Right.
What was in front of you. You didn't try to think too hard about what was happening.
Well, what I got into trouble was because during that time I was with a value-based hedge fund, and where I got all messed up and really where I kind of abandoned the value of value is that I started getting away from trading rules. And started incorporating more of the traditional orthodox investing world, and there's a place for it. I don't want to say it's completely useless, because it's clearly not. But pure trading on certain sides of capital works better than value, and certainly in that market, because all the people that I knew that were value oriented really got hurt in the '08 crisis. That crisis didn't show up in their in valuations.
Everything fell by half.
But the point of not being to get to the point of being ashamed, not knowing each other, is the going through the trials and tribulations of the markets is what makes you better. But back to the idea of that, my opinion doesn't matter. And the '08 crisis, I didn't know what was going on. Yeah. So what I do, I go to the internet. I'm looking for a guru. I'm looking for someone that knows more than me. So number one, that's what people do. And the other thing I would do a lot, I would remember, I'd be like at night on the phone looking at charts, and I'm like, what am I looking for? What am I looking for? And I realized, like, I'm looking to know the future. And that goes back to the whole point why it's not a great question, because in reality nobody knows the future. The markets can bottom here and make new highs, or it can continue to deteriorate. The only thing that you can control is what you do, is what your response to the market is, right? So that's the real question: is what should I do if certain scenarios play out? Like, what I think is going to happen is one opinion. It might not happen.
Exactly.
So then the next question is, well, what should people do? And a lot of people probably don't have a well thought out game plan, because crises don't happen frequently, and sometimes you get complacent, and when things are good, you also aren't as robust or flesh out your risk management that well. And part of the world kind of tells you that everything takes care of itself over time. And so the conventional thinking is sort of not to worry about it too much, which I don't really like that advice. Anyway, I want to stop there and here's what your thoughts are up to this point.
Yeah, to your point of not looking to gurus, I don't like to just give an opinion on the direction of the market either. I try to teach people something that they can take with them, that they can actually use. And one thing that I've been driving home for the last year, even though I'm a trend guy, I mean, we do trend, I've been beating the drum about value, because most people aren't going to make the effort to really understand trend and do it right with proper risk controls and diversification and everything. Most people are just in stocks or they're not in stocks, and you kind of have to give them an answer that's easier for them to take away, that they can use today and a year from now. And so if you just teach somebody how to value the market as a whole, forget picking individual companies, but just how to value the market as a whole, then you can just slowly scale in and out of stocks according to the broader market's valuation. And we have had, by any objective measure, the most expensive market in U.S. history. More expensive than before the crash of '29, way more expensive than before the crash of '87, which was really kind of a technical event. It was an overbought market. It was kind of parabolic like this. It had very high participation, high margin rates, et cetera, high margin borrowing, but it was not an expensive market by today's measure.
Right.
Today we're twice as expensive as we were in '87, and we're even more expensive than we were in 1999 and 2000. And so valuation it's imprecise on a short time horizon. We were expensive a year ago and we went up, but most people don't need to know. The short time horizon is irrelevant. It's much easier to just scale out and then a year from now, check the price again. And if it's a fairly valued market, you increase your exposure. If it's a cheap market, you go all in. But nobody needs to be exposed. Nobody except a trader needs to be exposed to a very expensive stock market. You don't want to hold a very expensive stock market. It's just going to go badly. It always has.
You brought up a really good point, and my mind's blanking out. Hopefully it'll come back. But why would you say a trader has to be exposed to an overvalued market?
Well, he doesn't have to be, except that there's no reason why he can't be.
Oh, sure, because he has the ability.
The problem with an overvalued market, any market can fall. A cheap market can fall. In 1931, the market had gotten cheap, but then it proceeded to fall by half again. It didn't stay down very long. It was so ridiculously cheap that it bounced back pretty hard. But that can happen. The market can do anything. It's just that the odds of a large decline are proportional to the price of the market.
I remember the really good point you brought up, which is that you said it doesn't really matter what happens in the short term.
Yeah.
And this is a really fine line that I want to dissect a little bit, because I don't like the way that conventional thinking says it exactly, which is kind of like everything takes care of itself in the long run.
That's just a blind faith in the stock market.
That's a blind faith in that's not what I want to support.
Stock markets in the developed world, in Europe, look at a 100-year chart of European stock markets. There were some periods in there in the first half of the 20th century when things went really badly. You could say, yeah, world wars. Well, yeah, world wars, depressions, these things happen. This is history. You're not immune from history.
Right. So in that sense, I don't like the advice that things kind of take care of itself and have blind faith. I mean, you want to have faith in the system and support system, but you have to have your own personal risk management. But what I do want to articulate is that these big down 10% moves, or these big moves in the markets, get a lot of the headlines and a lot of the attention, and we feel like we ought to act. Yeah. But in reality, they don't really mean that much to the bottom line at the end of the investment cycle. Number one is down 10% is a lot, but it gets, over time, compounding kind of takes away.
It doesn't matter. It doesn't matter what happens. I mean, you could have a strategy that's more volatile than stocks on a daily level, yet less volatile on an annual level.
Right.
I'd say that's a safer strategy.
Right. That's a hard concept for people to appreciate, because we live day to day, I think, and it's so dramatic. But that's exactly right.
Yeah, so 4.5% day, 10% peak to peak. It's really irrelevant. That alone means nothing.
And to some extent, contemporary society has adopted that. They take the volatility of stocks over bonds. Mm-hmm. As a whole, people like equity as an asset class. They're willing to take that volatility because over time they see that it has a better long-term return.
That's right. But what's not acknowledged, that's just people just have this blind, the financial press especially, but most investors, after we know when we've had a good bull run, there is this willful ignorance of the fact that stock markets can be underwater, deeply underwater, for years upon years. And that matters.
And that matters. And this is the hard part that most people don't have experience with, is how are you going to react in that situation? Yeah. From years of doing it, I know that me personally, I'm going to break at some point. I think the market breaks everybody. So my rule is, if you're going to panic early.
Yeah.
It saves a lot of heartache.
It is not too late to panic. Like, if you're going to panic tomorrow. I don't care what the market does. If it's down 10%, up 3%. If you're going to panic, if it's down another 30%, just sell. Just go to cash.
Well, then that segues actually to, I think, what's the most the best course of action. What people should really be thinking about is, what's my risk management?
Yeah.
What am I going to do in different scenarios?
Yeah.
And if you really think you can hold on and go through go through a bad period if it were to happen, and you had high earning and you can earn your way and keep adding, then God bless you.
Sure. I mean, if you're a true believer in dollar cost averaging into the S&P 500, then good, because that's okay. Like, if you're a young person and you have good income and that's your strategy, then just stick to it. Don't worry about any of this. Just do what John Bogle says, but don't forget 100 minus your age.
Right.
But what we try to teach people is that you don't have to do that.
Right. You don't have to do that, and what people can also take this opportunity with the market mayhem is to get in touch with, if they have their money management being outsourced to somebody and they're not doing it themselves, they can ask their money manager what's their risk management methodology, and I'll be telling, because what their response will be will let you know how they're approaching the markets.
Yeah.
And I would be wary of somebody personally that said, well, it's a wiggle and it'll all. Paraphrasing, but it's a wiggle and it'll all take care of itself.
I saw a note from an advisor to his clients, a fairly big advisor with some high net worth clients, that was basically that sentiment. Markets go through their wiggles. We had a period of calm. Now, a little bit of volatility is returning. This is normal. Maybe some economic commentary in there. That's not risk control. That's not. Maybe it makes people feel good to be reassured that this is all part of the process, and stick through it and you'll come out ahead. I think that's generally what advisors tell people. It's all part of the process.
Right.
Don't be a market timer.
And that's the thing. To some degree, it's academically supported. Conventional thinking is that you can't time the market.
It's just it's trivial to show that's completely wrong.
Right. So that's the challenge for us, because we have this belief that we've proven to ourselves. We have such a robust model that we can't find a market where you can do a simple trend following where you can't beat the market.
You beat the market in the model that we actually run for clients. It's asset allocation, and you can throw anything into that. You can throw in the U.S. market and the Japanese market and gold, or you can use Germany and New Zealand and copper, and make sure you have some bonds in there, and it'll work. It may not work as well as the formulation we do, but it'll work. And just like what you're talking about with different countries, you can run a basic trend following model on any stock market in the world, and it will beat the pants off that market over any time period that matters. It won't win every year. It won't win every month. It'll get left in the dust sometimes, and you'll feel like a chump. But run it for a decade, and you'll come out ahead every single time, unless that happens to be like the best decade that market has ever had. And even then, you'll do pretty well. You'll do pretty well. And when the market eventually turns, you'll get to keep your money. So, it makes people uncomfortable, which is why the edge is preserved. Anything that's easy to do and beats the market is going to get arbitraged away. So you got to pay some price, and if that price is psychological, that's a better price than a dollar price.
Right. I would think so. So I want to spend a little bit of time on this notion of timing the markets and the value of it. So conventional thinking says it's can't be done. Academics have spent a lot of research proving that it can't be done. Except those same academics have university endowments that are trying to beat the market. But that but that aside,
I think that's we should give the academics a little more credit. They're slow, but they're catching up. I mean, value and momentum are now acknowledged as legitimate factors.
Right. Right. I mean, yeah.
And Robert Shiller did win a Nobel Prize in large part for his work on.
No, and a lot of our work is built off their work. So
Yeah.
I'm not disparaging them, and I don't mean to disparage them in any way. I just
I just don't want people to think that we're these mavericks that completely dismissing what the academics are saying.
No, I mean, we think very highly. We think very, very highly of the academics, and what we've really done is just applied a little bit of trading knowledge onto their work.
We dared to look where they don't look. We dared to try things that the most dogmatic formulations of their theories would say don't work.
And even Schiller, that's why he's his area of studies, behavioral economics, which is trying to account for this area of markets that can't be explained through efficient market hypothesis, right?
Yeah.
So even he, I mean, from an academic point of view, admits that there's this area of the market that doesn't fit into.
Schiller's very good. He's, lately he's been talking a lot about narratives, the narrative that drives the markets, because it's
Well, I think when you start realizing the numbers that matter, you realize everything's just a narrative.
Exactly.
And nobody really knows what they're talking. I mean, the narratives don't really explain what's really happening.
Yeah, people just make it up on the fly. A theme develops to explain what people are doing, and like Soros said, it's a feedback loop. So more people get in because there's a narrative, and that narrative is being proved correct. So more people get in, and then it just it goes until it breaks like a wave.
So to the idea of timing the market, it's a quote I used on the last episode, and it's a quote I really like, and it's the value of at least trying to think about timing the market. I'd say, if you don't want to use those words, think about the risk management. But the idea is that it came from Marie McClellan of the McClellan oscillator, and it's that everybody's a market timer. Some people buy when they have money, and some people sell when they need the money, and other people use more sophisticated methods.
Yeah.
And what I'm trying to behoove our audience is to try to find out some better, more sophisticated method than just emotional panicking, or when you're flush with money, or when you don't have the money.
Yeah.
And then that gets into the realm of risk management. So where are you going to get in or out of the markets, if that's a game that you want to play? What would you say to the people that say, well, I don't have the skill set to do that. I don't want to play that. What's
I mean, you've got to have that urge to do better than the crowd. I mean, if you never check your statements and you just let it run, and the money's not that important to you, I don't know what to say to you.
Now, what do you say to the people like, okay, Ritger, I like what you're saying. I want to be a little bit more active about the way I'm managing my risk.
Yeah.
So, what should I do? How should I manage my risk?
There's a whole body of knowledge to bone up on. I can tell you that the two big factors that drive returns are trend and value. And trend is more powerful in the near term, it's not valid beyond the near-term future. Beyond that, you have to look to value, and value is very powerful and actually quite precise when you give it enough time to work. Give value a decade to work, it'll find the price. Over a decade, the market will compound out to to give you the kind of return that it's always given you for the price that it starts at. If that makes sense. If you're overpaying for cash flows, you're going to get a lower return over a decade. If you're underpaying, you might lose money at first, but then you'll make a bunch of money and catch up. Whereas if you overpay, you might make a bit of money in the beginning and then give it back. So it all evens out when you do value.
People that trade non-financial markets understand this better. Like if you trade cars or a home, the gain is in the price you buy it at.
That's right.
And so I think anybody so let's just say a car is worth $5,000. your whole profit is going to be whether you buy it at 4,000, 3,000, 2,000, or 1,000. Yeah. And that's the idea that the stock has this terminal value, which is growing some bit and is related to interest rate and the discount rate.
I think the difference is that you know what you're buying. If you buy a house, you know what you're buying. When you're buying a stock, most people don't really think of it as a tangible thing or anything solid. When a guy guys like Buffett and Munger think very differently. They think about the long-term prospects of that business. They think of it as a stream of cash flows that might last 100 years. And when you think of it as cash flows, you don't think about it as pie in the sky. You don't think about how some scenario is going to play out and it's going to make a ton of money. No, you think about what it actually is. If it's a mature, stable business, you know what it generates to the bottom line over the full economic cycle. Yeah, earnings might be a lot higher when times are good. Earnings might be negative for a few quarters in a recession, but it'll even out. And then you'll see, you take a running average of earnings like Robert Shiller does for the S&P, and you'll see that everything's smoothed out. So you kind of know, extrapolate that growth line out 10 years, you kind of know where those cash flows are going to be in the future. You don't have to worry about the quarter-to-quarter earnings reports. My goodness, it's just such a silly game to play. And when you look at the market as a whole, everything just gets so much easier because you don't even have to pick the right companies. So, yeah, you just look at the sustainable earnings of the market as a whole. And you can think of it as a solid thing. The cash flows generated by the U.S. economy, by the biggest companies in the U.S. or England or wherever you're looking at. Just look at the public equity sector as a whole and the cash flows. It's like a claim on. It's like you can almost think of it as a bond. It's a fairly steady stream of cash flows.
Well, that's exactly how Buffett looked at big, stable American companies.
Yeah, think of it like a rental apartment. Like you're thinking, all right, this guy's going to pay $1,500 a month, and there's going to be, on average 6 weeks of vacancy a year. And I'm going to have to pay the property manager, the realtor this much, and property tax and maintenance. And at the end of the year, I'm going to have, $5,000 in my bottom line if I buy this apartment. And maybe next year it'll be $5,500. Or 5,200 or whatever, factor in your inflation and your estimate of economic growth, and what that cash flow stream is going to be. You're not going to buy an apartment, you shouldn't, unless you're going to fix it up or it's like some truly up-and-coming neighborhood that you have a great case for, but even then you're speculating. I would say just, think of it as a stream of cash flows, as if you're buying a rental property or as if you're buying a bond or an annuity or like some kind of an insurance scheme or retirement stream.
So this touches on a little bit the difference of the way institutions look at the markets versus retail. So your average retail person thinks of it in terms of growth stocks and stories, and in those businesses, the cash flow is not as predictable or stable, and so it's a different class of.
Most people gamble. I mean, 100 years ago, everybody had a bookie.
Really?
I think I've been watching Boardwalk Empire. Have you seen Boardwalk Empire?
No, no.
You're from Jersey too, so you should watch it. It's really good. But I get the impression, in the old days, you always knew where the poker table or the craps table in your neighborhood was. So people have this urge to gamble. It seems to be a universal thing, and these days that urge is channeled into the market. And if you take a systematic approach using indices and you aim for a good risk-adjusted return, it's just, I don't know, it's not very stimulating. Whereas if you're picking stocks, when you win, it gives you the illusion of skill, and the stakes are higher and more thrilling, and you have that blue sky possibility. If you do a risk-controlled, systematic program for investing in, the major indices of the world, there's no chance that you're going to have 10 times your money next year. It's just not going to happen. So
I want to spend a little bit of time, because it's really important. really important framework to develop about the way you think about investing. So the attraction to these great stories like Bitcoin or this cryptocurrencies or the small cap or the weed stocks is this ability, the dream, the 10 times, 100 times your money. And you can do that, maybe pursue that when you're younger and don't have much money, or you take a small fraction of your money to do those speculations and gambles with. And this is what I want to get into. But ultimately, it's not worth it because
I think it's no. If you're younger, absolutely, like open that Roth, put $5,500 in every year that you're eligible, and let it compound, tax free for the rest
well, that's
of
a good point too. I would say that's right. If you're 20, you shouldn't do that anyway because you should
just do that.
Let
Roth.
the time work for you.
Find a compound annual growth calculator and see what that'll do for you later in life.
Right, don't get seduced. Don't get seduced.
Here's the thing about the stock market. People don't realize how risky playing it is. And so they look for the kind of thrills that they'll get at the poker table with real money.
But or with a fraction of their money. That's what my point is, that you're better off figuring out to do something solid and robust with the lion's share of your money than spending all this time and effort trying to figure out how you should gamble with your little bit of money. Okay, you're gonna, even if you get right, you get it right and you make 10 times your money in your little pot, what is it going to do for you in your overall scheme of things? So. But that's those are the attraction, and people. I think the attraction to the 10 times your money and why people get attracted, and they're like, oh well, let me find the next one, I'm guilty of it too. In my younger days, I was guilty. I'm guilty of it, and that's where I feel that the learning lessons come from is to avoid that road.
Yeah.
Except for one thing, is that road teaches you the process and the skills of what actually works.
That's true. That's true. Very few people actually learn that. But the people who make those mistakes, and everybody makes those mistakes, people think they know things. That's the craziest thing about the markets. People think they know things. They come in knowing nothing. They've not read books. They don't have any experience. And they just apply regular old logic and theories to the market.
And this is expands into the realm of learning anything. I'm a big believer in getting the experience, of how things work, because it's really difficult to learn how to swim by this proverbial learn how to swim by reading a book. You got to jump in the pool. Mm-hmm. Same thing with anything you do, and a lot of things when you really start doing them, they're so counterintuitive. Yeah. And once you start doing them, you're like, oh. We keep saying the same thing, but the trend is your friend. From a logical point of view, makes no sense.
Yeah, I've seen a lot of this in Bitcoin. I mean, it was obvious to us when it made its super spike. We said, you don't know how high the spike is going to go, but when it stops going up, it's over. It's just like silver in 2011. Crazy spike, but it doesn't last long, and when it stops, it's over. And so the thing started falling, 15,000, 13,000, 12,000, and people were buying it like it's a value deal. Right,
because it was at 20,000.
And I was saying no.
Now it's at 5,000. It's 75% off.
Like the more it goes down, the more bearish you should get. It's not a. That's the most purely irrational, untethered market imaginable. Because there's no fundamental anything there. It's not a claim on cash flows. So there's no Warren Buffett who's going to step in there with a bid when it gets to $1,000 or whatever.
I wanted to spend one of our episodes talking about that because it parallels what happened in the late 90s with me and the lessons I learned with it. I don't think we're ever going to get to it because the interest in the market's going to take over, and it's kind of probably going to fall by the wayside, the interest in it. And one of the things, me personally, I didn't want to talk about it in the past, even though I think it would have been an interesting topic for maybe people, is because it would have fallen on deaf ears. It's hard to convince the believers of something that there's risks that you need to manage and control. But one thing I do want to say is that it went up to 20,000. It's fallen to 6,000. It was only at 6,000 in October or September, and that was a big run from at 6,000. It was people felt it was crazy, and they made a lot of money. So, you kind of put it to put it in perspective is that even at 6,000, a lot of money's been made, and you may want to think about the risk management. And the problem is that people older than us, and even us included, get dismissed. Our views get dismissed because the fact is the believers are the ones that made all the money, and it's hey, see, look how much money I'm making in my bank account. It's not the numbers don't lie.
That's right. People have been telling them they were silly to keep a lot of money in this thing since it was $1,000, and so they feel they know more than everybody else.
But what I would behoove you to do, if you can do it, is put your Bitcoin chart and superimpose it on any of the great runs in history. So you got the Dow in 1929, you got the gold move in 1980, you got the Nikkei move into 89, you got the silver move into 211 and into 1980, and the Chinese stocks in into 2007 or 2005.
2007, yeah.
2007. So and you'll see the identical charts, and you see it all unwinds in a very similar way. And that doesn't mean to say that there isn't merit to the blockchain. There may be. I don't know. But what the price of something is and the merit of something aren't exactly the same thing.
Yeah, I mean, if the stock market can move by, a factor of 10. From a cheap market to an expensive market valued over cash flows. If the stock market, something as well understood with as clear a fundamental value, you're talking about real estate, factories and cash flows. If people can disagree about its worth by a factor of 10, how's anybody going to agree on where Bitcoin should be?
So bringing it back to the fluctuation, the volatility of the market, we covered some ground. We're running out of time. Is there anything outstanding that you want to communicate to our viewers, or?
No, just have a plan. I mean, you need a plan. It's better to have it in advance, but it's not too late. It's never too late. So.
I got a great quote from a friend who was quoting Michael J. Fox. Might be, I don't know if any people remember him as an actor, but it's never too late to do the right thing.
Yeah.
And so sometimes you feel like I missed it. No, you don't miss anything, and you operate in real time. And there's
don't freeze up. People freeze when things start going against them. A good trader doesn't freeze. Something goes against him, he just sells. He's just out, closes the position, goes to cash.
And so when we talk about that, sometimes people equate that to a personality type. I want to say that that can be a learned skill, and you can eliminate the need for emotional reaction by having all your if and what if scenarios in place first. So if this happens, I do that, and then you make it consistent with your philosophy. So as trend followers, as markets decline, we want to offlay the risk. If someone's a value person and has a good measure of value, and as it decreases, they want to increase, then do it. But it's good to it's good to make your plan.
Make it in advance.
Make it in advance.
If you're going to buy this market when it gets cheap, define what that means. I mean, it could be as simple as I think the Dow's a good buy at 20,000. I'm going to start buying some, and then I'll buy more at 16,000 and 12,000, and I'll be all in at 10,000. I'm going to lever at 8,000. I mean, if that's your plan, that's fine. It's even something as simple as that, if you stuck to it, would work just fine. But don't abandon it. Don't abandon it. It's better to use, to define it in terms of fundamentals rather than just price. Look at Shiller's Cape. But that would be a perfectly good plan, and it doesn't require a whole lot of learning. It doesn't require it doesn't require you check the market every day. You check it once a quarter, once a year. And that's a plan that will beat the markets. And if you're a trend guy, you've got to be more active. But you still have to define.
Well, you have to be active, but it's not like you have to be daily active, because one day does not a trend make.
Yeah, you can go a year between trades with the trend system. More. So both those things are possible for any person at home to do, just with a little bit of effort and belief. I guess it starts with the belief that a little bit of active management can make a dramatic difference in the results. That's right.
and that might maybe make a maybe then people should spend a little time researching on their own to get convinced, and that's what these markets kind of do, right? When the markets go up, passive investing is beating everything, and why would anybody do anything else? It's the adversity that forces us to get better and learn, and people are more willing to spend the time to learn some other things.
Right. I feel like the science of trading, the kind of trading that we do, really came out of the bad experience of the 70s. The markets went, sideways to down for 16 years, and you had people figure out ways to cope with that.
And I think a lot of that came out of the commodity guys that were the traders. So I mean, this is what I've heard is that J. Aaron was a commodity trading division that Goldman acquired sometime. I don't remember exactly when. And the guys that came out of J. Aaron were the traders, and they're the kind of the ones that became in all the management positions at Goldman Sachs, which is why Goldman Sachs is really not really a bank, but more really just a hedge fund. The trading culture infused really the organization.
The one bank that didn't blow up in 08.
So I don't really have too much else, and I guess we'll see what's going to happen with the markets. Again, I have an opinion, but it's useless.
Yeah.
And I, like everybody, don't know the future, but I do know how I'm gonna react in the future, and that anybody can do.
That's right.
Thank you for watching.
See you next time.